In this week's video, we'll address two questions. The first, did we see any meaningful improvement in the stock market this week? And second, how likely is a 2008-like plunge in stocks? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. These are the moving averages that we use to illustrate concepts. I want to emphasize that the market model is a lot more than moving averages. This is the S&P 500 in 2014 as of the close a week ago on October 17th. This is the S&P 500 during the flash crash correction. The flash crash was not a one-day event. It was a 2-month correction in the stock market. So where we are a week ago Friday, you can see there's many similarities here. Price is below the 200-day. We have moving average crossovers. Price is below. The fastest moving average is crossed below. A lot of similarities to 2014 in this period here. Where we are as we step through, we're trying to discern, are we getting a counter trend rally that will lead to a lower low, or does the current rally look more like a reversal? Same chart as of Monday, October 20th. Not much in the way of observable improvement yet. As of Tuesday, October 21st, we do have some observable improvement now. Price is above the 200-day. Price is above blue. The slope of blue has turned back up, and the 50-day in green is starting to flatten out. This is starting to check some bullish boxes in the CCM market model. Thursday, October 23rd was a down day, but not much change. Slope is up, slope is turning up, slope is trying to turn up, slope is flat. So some encouraging signs. This looks a lot better than this, or this. As of Friday, October 24th, at 1:38 p.m., some differences here. This is a counter trend rally that led to a lower low. But look at the slope of the 50-day during this counter trend rally. It's clearly down, telling us that the intermediate term trend is weak here. Contrast that with the present day on Friday. Look at the slope of this versus the slope of this. It doesn't tell us what's going to happen next. It just tells us the probability of clearing the 50-day is probably higher here than it was here. How do we account for the fact that this is still a possibility in 2014? Our allocations take care of that. We have stocks. We've added to our stock side, but we still have cash and bonds that are acknowledging this market has some work to do. Once we get up here, it gets even easier to scale in at a faster rate. Our objective is not to capture a multiple day move like this. Why? Because it might be retraced from a probability perspective. Our objective is to put our capital at risk as the odds improve and to capture what we hope would be a multiple week or multiple month rally in the S&P 500, giving us time to scale in as things improve. What a difference a week makes. It's important to remain flexible. Last week, things did not look good. However, as stated in this clip, we did say that bullish outcomes were possible, and that's why we have to keep an open, unbiased, and flexible mind. If we don't have all that, it's next to impossible to see and adjust when the charts start to improve as they did this week. Is it possible that the S&P 500 blows through all of these levels and we rally? Absolutely, positively, yes, it's possible. But we need to see evidence of improvement rather than anticipate it. We may see it, and if we do see it, we're happy to take action. Why did we add to our equity holdings this week? Because the evidence improved. Last week, our weekly chart full bore bearish look. Now we have an improving and mixed look. Why do we still have cash and some bonds on hand? Because the observable evidence has improved, but we still need to see more. If the S&P 500 is to rally for weeks or months, we will get a bullish moving average crossover relatively soon. This is telling us that the probability of reversal in this look is higher here than it is here, and that's why we step in incrementally. Everything that we said about the S&P 500 chart applies to the stock versus bonds. A week ago, today, the 24th at 10:46 a.m., observable improvement, still has some work to do. We want this to morph into a look like this. It's important to note that the market model is a lot more than moving averages. The market model literally answers thousands of questions about the market, and the vast majority of them are not directly tied to moving averages. Here we'll show some of the indicators that we use. We may or may not use them on this time frame, and we also use custom settings for the indicators. For illustrative purposes here, we'll just use the standard settings from stockcharts.com. Purpose of the exercise: we're trying to understand the probability of the present day market morphing into something like this rapid plunge that occurred in 2008. This is the relative strength indicator. You can see here before this happens, we're below 50, and this indicator has been weak for quite some time, including a weaker move here relative to this move here, which foreshadowed probabilistically this first move down. How does this indicator look today? The answer: much, much better. This is the same indicator over the same time frame as of the close on October 23rd. You can see the trend here, or the readings on RSI, are much, much higher in the present day than they were here during this higher risk period in stocks. This just tells us that the probability of the present day market morphing into something like this in the short run is relatively low. It's not zero, but it's not a high probability outcome. It takes time to morph into something like this typically. Since the concepts are similar, we'll move quickly. Most of these indicators are used by the market model, not all of them. This is simply for illustrative purposes only, illustrating basic concepts, not the actual readings or charts used in the model. MACD, how did it look before this low probability period? Black was below red, and you can see here we hit the zero line before this big plunge. How does it look today? It's showing some weakness, but this looks much, much, much better than this. The black line is up above 125. 125 isn't even on this scale. Monthly Williams percent R. Notice when this started here how low the indicator was, and when this started here how low the indicator was. Present day looks much, much better. What does it tell us? It tells us that the recent weakness in stocks is more likely a correction than the beginning of a bear market. More likely speaks to probabilities. It doesn't mean that the stock market might go on to make a lower low and still correct for several weeks or several months. It just tells us that an event like this is still a relatively low probability outcome. Same exact concepts, the ultimate oscillator. Notice the level here before the waterfall decline. Same indicator, same settings, same time frame. Looks much, much healthier in 2014. monthly commodity channel index. Notice the level here and the levels here. Level here before bad things happened. Like MACD, the present day is showing some weakness relative to these points here, but this looks a lot better than this. Monthly force index, ugly. The concepts are similar to the moving averages. Observable changes take place before bad things happen. This really doesn't look much like this. Full stochastic, when we get this bearish crossover, does it forecast that this will happen? No. It simply tells us that the probability of bad things happening is increasing. Break 50, the probability of bad things happening is increasing. Observable helps us with probabilities, doesn't forecast anything. This is the look here when bad things start to happen. Look at the level, well below 80. We're still well above 80. We are showing some relative weakness, but we're still in quote-unquote overbought territory for the indicator, which tends to lead to good things, not bad things. Bad things start to happen when you drop out, typically. Tricks, black below red, dropping like a stone. Tricks today, much better. ADX, red crosses green, the probability of bad things happening increases. Today, green still above red, black above, showing some relative weakness here, but if you study ADX, markets can go up for a long, long time after this black line starts to drop. We've talked about the fibs a lot, so we'll move quickly. These are the fibs a week ago on October 17th. This week, we plowed right through them all, telling us that the probability of making a lower low is now lower. It doesn't mean weakness is off the table. It just says we're probably in a new uptrend from a probabilistic perspective, hence why we're scaling in a little bit. The market can do anything at any time. This just helps us with those probabilities. I've been working on Wall Street for 20 years, and this week I said in the office, I don't recall seeing anything like this coming out of a market profile that we had coming into this week. We'll get to more of that in a moment. October 24th. Here you can see the VIX breakout in fear has been taken back. As long as we're below these lines here, the probability of good things happening is higher. Last week, the jury was still out in terms of whether or not the breakout would hold. This week was unusual and some unprecedented events took place. You can Google this title to find the details on our blog. Short takes. We know the probability of bad things happening increases when we drop out of overbought. Conversely, when we come out of oversold and clear negative 50, the probability of good things happening in the stock market increases. Clear 50 here after being oversold. Eventually, good things happen. This week we cleared negative 50. Does that mean we're out of the woods? No. It just tells us that the probability of good things happening is higher today than it was a week ago. Some more observable improvement. This is the chart of small caps that we covered last week. It was as of 11:09 a.m. last Friday. This was potential resistance. What once was support may now act as resistance. This week, a week later, we recaptured these areas, all things being equal. That's a good sign for the stock market bulls. We noted in an article earlier in the week that we wanted two things to happen this week. We wanted the S&P 500 to close above the highest fib at 1943. We did that. And we wanted to recapture 10,301 on the broad NYSE composite. Retest looks successful at this point. The longer we stay above these lines, the higher the probability of good things happening. We showed you earlier that we recently had an unprecedented move in the VIX, which was a fear reset. That was unusual. This is unusual too. In 1 week, we took out 1, 2, 3, 4, 5, 6 areas of potential resistance, with the Dow closing this week above this blue line. What does it tell us? It just tells us that the probability of good things happening is higher today than it was last week. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.